On paper, the economy looks just fine. GDP is still growing. Stocks are basically at all-time highs. People are still spending money, sorta. But when you zoom in on the real economy and you look at the wage data, the spending data, the credit data, the stress data, all of that has a different look to it. Wages are split, repossessions and foreclosures are ramping up, the Fed's fighting with itself, and stocks are making this weird rotation. So we got to talk about everything going on. And I think we should start with the part that nobody's talking about, which is this split economy. So right now, and go figure, the trends show that the top 25% are favored right now, with their wages growing 4.6% a year. The bottom 25%, they're only seeing about 3.6% a year, which is half the pace they were getting back in 2022. And this is coming from Atlanta Fed wage data. And people keep talking about this K-shaped economy. What the heck is a K-shaped economy? Never heard that in my life. So I did some digging around, and here's how I understand it. Imagine this letter K, and you could kind of see it on this screenshot right here from my iPad. There's this top line, and that's the higher income folks. They have wages and assets and more opportunities. They're going up. And then there's that bottom line that represents the lower income households. In this case, it's flat or going down. So instead of everyone rising together or falling together in this case, you get these two separate realities in the same scenario. And Bank of America data shows 29% of lower income households are now living paycheck to paycheck. That's up from 27% back in just 2023. Nearly 1/3 of low income households struggling, while some of the mid-income households are too, but some of the upper middle income and the higher income households, statistically, they're not sharing that same stress. And especially when some of the essentials like ground coffee are up 40% in the past year, ground beef up 11.5%, bananas up 8.6%. So yeah, technically inflation's slowing down or slowed down a little bit. But if your grocery cart and your pour is made up of coffee, which a lot of people drink coffee, ground beef, a lot of people eat ground beef, and then you got gas and rent, bananas, it doesn't feel very good. And that's where this stress data goes from uncomfortable to tough, because then we get into repos and foreclosures and how those are picking up. So right now, 1.7 million vehicle repossessions were announced back in 2024. This is from, what was the company? Cox Automotive. That's up 43% from 2 years ago, and the highest since 2009. But they're expecting that number to increase even more from the subprime auto crisis we had just a couple months ago, where they were talking about cockroaches and all of that stuff. And then we go on to subprime borrowers who are 60 plus days delinquent on auto loans. That was 6.5% in October. Look at this chart. That's a record high. And then you got foreclosure filings. Those are increasing up 20% in October versus just a year ago. Nearly 37,000 properties seeing default notices, auctions, bank repossessions. Really a tough time out there. So lower income households, they're clearly getting hit. It's so obvious. And there are way more lower income households than there are these rich people driving Teslas, buying AI stocks. And when wage gains are and spending, when those are clustered at the top of that K. Here, I'll put it back on the screen. When they're clustered at the top, the whole economy becomes more sensitive to financial markets and less anchored to normal paycheck income. Yeah, if you're rich, you're still spending pretty good. It's all good out there. But your spending is tied to asset prices, stocks, housing, crypto, option YOLOs, not just your paycheck. There's this guy, Jared Bernstein. He is the Council of Economic Advisors, and he says that for every $1 drop in stock market wealth, which gives like this wealth effect, when your stocks are going up, you feel more rich. When your stocks go down, $1, in his opinion, there's this 2 to 3 cent less spending that funnels through the economy. And yeah, that it's change. We throw our change away, right? I don't. But that doesn't sound huge until you consider that that's trillions of dollars worth. So we end up in this weird economy where the top 25%, they keep things going while markets are up. The bottom 25%, they quietly bleed out through these delinquencies, repos, foreclosures. And as long as the markets levitate higher, headline GDP looks fine. But once markets begin to wobble just a little bit, the whole thing becomes more volatile. When more of the stress is concentrated at the bottom, it doesn't always show up in the big flashy numbers first. Instead, you see things like rising delinquency rates, shrinking savings buffers, pullbacks in discretionary spending at places like restaurants, small retailers, travel, and those are the businesses that rely on broad demand the most, not just those high margin, wealthy customers that are spending a ton right now. So you can literally have positive GDP, like we do, lowish unemployment, record stock market, and at the same time, still have record subprime delinquencies, rising foreclosures, more households one paycheck away from losing it all. That's the K-shape. So what do you do if you're the Fed at this point? You've got this softening labor market. Maybe keep cutting rates or people at the bottom get crushed, and that's the majority. And now as a consequence, you got 5 years of inflation running above target. That's the Fed's toolkit right now. It's basically a hammer. They can move interest rates. They can play with the balance sheet a little bit. They can talk. What they can't do though is target just low income wages or surgically fix the repo spike or only help renters without helping out the asset owners. Cutting rates will ease all financial conditions, but that mostly helps people who own assets, the rich people. So you end up with this situation where, all right, you could cut too much, maybe reheat inflation and maybe widen that K even more than it was. Or if you're the Fed, you could choose to cut too little, risk a sharper slowdown that hits low income workers much harder, way harder. And that's exactly the tug of war we hear and have heard this week in the Fed commentary. So today, Kansas City Fed President Jeff Schmid, he dropped this full-blown hawk speech. He was just hawking the entire time during this speech. It was called Maintaining the Balance in Monetary Policy. He was the one who dissented against cutting rates 2 weeks ago. But his core stance from this speech was that the economy is still showing up with momentum, inflation still running above the 3% range, above target and spreading. The labor market's cooling, but it's not collapsing. And he's hearing from these businesses that these input costs like healthcare, electricity, insurance, all of those are showing rising. And these aren't tariff related. So we're not even considering the tariff stuff yet. And then once you get into the labor market, he basically says, yeah, job growth slowed to around 25,000 a month, unemployment around 4.3%, but that's not a recession, that's just structural. Because of these retiring baby boomers, immigration slowdown, slower labor force growth overall. So from his perspective, weaker job growth doesn't equal a demand crash. It's just demographics and supply, not this cyclical slowdown. And if that's true, from his point of view, cutting rates aggressively doesn't fix this. And then he gets into policy. This is the part markets are probably asleep on. His view is, Schmid's view is that the Fed has cut twice this year, and that puts the policy rate around this 4%. Stocks are near all-time highs. Credit spreads are tight. Consumption is still solid. software and IT investment hitting records after records. So he's basically like going through all this like, all right, rates are here, 4%, stocks are up, AI. And then he goes and says, hey, if this is restrictive, it's the most comfortable restrictive I've ever seen. So he's thinking policy is only modestly restrictive and inflation risk is much higher. It's the priority here over the labor market. He also throws shade at over-relying on theoretical stuff like R star. That's the neutral rate. He rather leans on this real-world data from businesses, districts, and markets. So the bottom line we got from Mr. Schmid today is that he doesn't, further cuts could have long-lasting inflation effects, and they don't fix the structural labor market issues that we're seeing. So right now, he's choosing inflation over extra easing. And what markets heard from that, once we pull up the CME Fed Watch tool, is that, oh my gosh, they don't want to cut rates. They've been hawking at us all freaking week, and now the odds of a 25 basis point rate cut, the odds of a 0.25% cut, the third cut of the year, which the dot plot showed that we would get that. Markets have been pricing that in forever. It's only 45.8% now. So what comes next would be watching for the data as it comes, because even with all of this noise and it appears just to not stop, we'll be getting this jobs data soon. And that's what everybody's going to be watching. We were hoping for October. We might not get October, but economists at RBC still think the U.S. added 30,000 jobs in October, excluding shutdown effects. We don't know if we'll get October before the Fed meets December 10th. We know we're not getting the unemployment rate at all, but we'll at least get that jobs creation number. So RBC is basically saying that's break even. And the trickier part would be inflation, because remember, the people getting hit the hardest are at the bottom of that K, the lower income earners, and that makes growth more narrower, more dependent on higher income spenders. But the Fed's mandate, it doesn't fix inequality. They care about maximum employment, stable prices. So over the long term, yeah, rates might come down a little bit. It might get easier in the economy. They might ease more, just not necessarily in a straight line, like not in December is kind of what they're saying. That's the grounds they're laying. And it all depends on what happens, especially data-wise. So we did get some clarity regarding data from the BLS today. They came out and they let us know that we get the September jobs report November 20th, and then the real earnings, these are inflation-adjusted wages, we'll get that on November 21st. So the Fed will have some time to kind of sit on and chew this data before their December meeting, but Schmidt's hawking, it just didn't sit right with markets. So today in markets, what we seen here, let me pull it up real quick. The S&P 500 has had their worst day of the month, down 0.05%, so not even a huge move down, but it still finished the week up 0.02%, just 2% away from its record levels. The NASDAQ, that one was up 0.13% today, up 0.4% on the entire week. The Dow, that one was down today 0.65%, but it was up 0.5% on the week, less than 1% away from its all-time highs. Then we look at Bitcoin. This one just keeps on falling. It was down I guess it depends on where you look. I was looking on Robinhood. Oh, it bounced because we were as low as 94 when I watched, and it bounced right off of this line, sorta. We'll probably keep on trading down, but it looks like it's only down 1.6% right now. But it was down 24% since October 6th, bear market territory. But so far in markets, what we're seeing is every single dip, that one's getting bought up. They're just waiting on the sidelines to buy the dip. That's just kind of been the move. And honestly, all of that makes sense to buy the dip because we're still in this rate cutting cycle. Of course, not financial advice, just looking back in hindsight. We're in this cutting rates environment. And even with December being 50-50, we've gotten lower rates, easing financial conditions. The AI wave is still intact. The core names haven't been broken. They're still earning massive money. Yeah, we look at CoreWeave, and that specific company's down 43% in a month and had supply chain issues for data centers and debt heavy players in this AI space like CoreWeave and Oracle. They're getting punished right now, but the pillars, think like these companies like Nvidia, they're still up. And I think we got Nvidia earnings coming up here pretty soon. So the market has basically been doing this two-theme trade: AI growth and rate cuts. Both of those have wobbled this week, hence the volatility we've been seeing, but that doesn't mean neither of those themes are dead. Analysts are expecting for tech earnings over the next year to be up 9%, or tech earnings over the next year are up 9% in the last 3 months. That's double the broader S&P 500, and then global investors are still shipping money in, on pace to send around $134 billion into U.S. equity funds this year, the second largest on record. And this leads to people thinking, all right, if only we could get past this hard landing, we avoid that scenario. If only we could avoid that. That means the AI trade continues. That's the big theme of the year, and we just keep on going up and we keep on partying. But let's get back to stocks real quick and talk about this concentration, because there's this concentration and rotation going on, because this is where you're seeing these charts I'm looking at on the screen. This is kind of where this gets important. So let me switch the screen real quick one more time. So in October, we're going to look at the S&P 500. And what we see for October is that was down 1.5%. 40.7% of the entire index that's concentrated in the top 10 companies. 35.1% is the information technology sector alone. So when you say the market is up, and we've been saying that, you're mostly saying a handful of mega cap tech and AI names drag the index higher, not the entire index. And back to what we were talking with that K-shape, remember? So from October 31st through November 13th, healthcare is up 5.9%, energy up 2.7%, materials, consumer staples, financials, and then you go negative with real estate, 0.1%, utilities down 0.4%, communications 1.7%, industrials 1.9%, consumer discretionary down 3.6%, and then the information technology, that large weight, 4.4%. And a couple things really stand out. Tech and consumer discretionary, the classic risk-on growthy stuff, they're at the bottom right now. Healthcare, energy, staples, more of your defensive, cash flow heavy sectors, those are what's at the top. So while the S&P is hovering near record highs, we see that money quietly allocating differently out of these crowded, expensive AI and IT names into sectors that either benefit from inflation and pricing power, think like healthcare and energy, or are much more seen as recession resilient, like some of these staples. And this is what you see when investors begin kind of like quietly panicking, but they're not really panicking. Remember, everything's just fine. But just repositioning for maybe volatility down the road and maybe a slower economy while still playing the game, because they don't want to sit all cash, right? And now on the screen, we're looking at the S&P 500 in days since its last 5% pullback, and this is on the chart. So this chart tracks the S&P 500 and the number of days since its last pullback of 5%. And the average shows since 2010, that's 77 days. So right now, we've gone much longer than that since a legitimate 5% drop, and the last real shakeout was back in April. So where does that lead us? It doesn't guarantee a crash is down the horizon, but it does say we're in this stretched low volatility window. And then you combine that with heavy AI concentration and big K-shaped split in the economy that shows to be like spreading further away from each other. Hawkish Fed voices pushing back on rate cuts, and still they're bullish internationally. So we got these global flows into US equities, and you've got this setup where any negative surprise on inflation, jobs, AI earnings, it could finally trigger that 5% plus reset everybody's been waiting for. But as long as we avoid the hard landing, dip buying, and AI, it probably keeps belling this market out. And of course, what do I know? None of that's financial advice because that could completely be wrong. It's just a weird time. So where does all of this leave us, and what does this say about the economy? We're running into two economies at once. The top 25% has wage growth and assets. They're still spending pretty good, and that's where all of the headlines are coming up with. Consumers are holding up pretty strong. The bottom 25%, we're seeing repos, foreclosures, food inflation impacting them, and this demographic is living paycheck to paycheck. And then the Fed's stuck in this middle spot. We got these hawks like Jeff Schmid today saying inflation's still too hot, everybody. Policy's not that tight. We don't need to get more cute with cuts. And then markets are meanwhile pricing in this cut cycle, just not as aggressively as before, and they don't really like it, I'll tell you what. Broad indexes, though, are still near record highs, but under the hood, there's just this stress and divergence going on. And we're probably overdue for some decent pullback at some point, but that some point, that could happen whenever, even years from now. So we did just look at that days since 5% dip chart, and I mean that's kind of pointing and saying we're stretched. You know, markets try to outprice it, price in everything and outsmart everybody. So you never know, but every single time we wobble and flows and buybacks and AI optimism, all of that just shows back up to save the day. So when you see those headlines that says the economy's fine, markets are at record highs, just remember the headline is doing okay. The headline economy is just fine, like I said. But the bottom of the K is struggling, and the Fed is trying to manage both with one tool, and I'd imagine that's super hard. So I'll keep walking you through all of this as it develops because it's getting pretty into the weeds of it. By the way, if you found this video helpful, hit like so this gets pushed out to more people who aren't seeing this side of the data. Drop your thoughts in the comments. Let me know what you think about all that we've talked about today. And I'll see you in the next one.